Chairman. And Chairman Powell, congratulations on assuming this incredible and awesome responsibility for the country. I'm going to ask you the same question I've asked each of your predecessors since I've been a member of this committee. When does America get a raise? And the reason I'm asking that question is because we've obviously been through a protracted period of time in which wage growth has been fairly stagnant. So before you answer, sir, I know you're probably going to make some indication of the uptick in the latest report to wage growth of 2.9%. And I just want to qualify your response by reminding you that that 2.9% was probably impacted by some transitory or one-time bonus payments. And if you disaggregate the data between supervisory and non-supervisory employees didn't get anywhere near 2.9%, was quite a bit below that. And 2.9% even in and of itself, despite how encouraging we may or may not put it in the context of the last 18 months or so, is significantly below modern historical averages of closer to 4%. I'm really interested in when is this economy going to function and grow in a fashion that enables Americans to get a meaningful raise?
So over time, wages should grow in keeping with basically the sum of inflation and increased productivity. So if we assume inflation is going to be around 2%, it really comes down to productivity. Productivity since the financial crisis has averaged output per hour, has averaged increase of about 0.5%. And so, and if you think about wages have been increasing at about 2.5%. So that's why, and before the crisis, wages were increasing at full employment maybe 3.5%, and that's because productivity was 1.5%. So we really need, if we want wages to go up on a sustainable basis over a long period of time, and that is what we want, we need to have more productivity. And that's, unfortunately, that's not the things we have the tools for. But that really is.
But is that true, Mr. Chair? It seems to me that they're not unrelated. To the degree that you keep your foot off the brake and allow unemployment to continue to fall, and I'm going to return to this issue and some things you've said on the record in the past about whether or not we should be looking at unemployment rates or wage growth as a measure of full employment per se. But to the degree that we keep our foot off the brake and allow U3 or U6 or pick your measure to continue to drop and continue to create pressures in the economy for wage growth to continue, does that not in and of itself incentivize businesses and employers to invest in labor-saving devices? Read here, improved productivity. Is it not possible that improved wages themselves can help lead to improved productivity, which can create a virtuous cycle with wage growth over time?
Yes, and that is exactly what we hope is happening right now. So
you're committing to keep your foot off the brake. When I was getting ready for this hearing, I went back and read something that you said in your very first year on the FOMC committee. At the very first meeting, one of the bank presidents mentioned tighter labor markets. And you noted that you haven't seen anything in the wage data yet to support that. And it struck me as interesting because it got me into thinking about U3 and U6 and my frustration with both and how it's been, I think, 2.5 years since we hit the supposed definition of full employment, yet U3 keeps dropping and the definition of full employment keeps chasing it. And it made me wonder, as it relates to what you said earlier, why don't we just use wage data to help define what full employment is?
Well, we use it as a factor to look at. But look, I think it's important to see, though, that for a long time there was slack in the labor market, and that argued for continuing to support lower unemployment. We've reached the point where the risks are really two-sided now, and we need to keep that into account, because if we do get behind and the market does, the economy does overheat, we don't see that now, I hasten to add, but if that does happen, then we'll have to raise rates faster, and that raises the chances of a recession, and recessions tend to hit vulnerable populations the most. So that's why we're raising rates on a gradual path. We're trying to balance the risk of getting inflation up to 2% with the risk of the economy overheating.
Fair enough, Mr. Chair, but I would only observe that you tap the brakes at the expense of the people who have, over a long period of time, not received a raise.